Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which of course makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make any sort of investment decisions, and the clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers. So let's talk about the four things we learned in the markets this week, starting with point number one. Point number one was, as I discussed last week, the returns for the markets for the month of June were going to be predicated on what happened this last week. With a Federal Reserve meeting happening and the consumer price index, which of course is inflation, and the producer price index, which is also inflation, with those numbers coming out, many of the things the market has been worried about for the last year, the I's, inflation and interest rates, we received a lot of guidance this week around their future possibilities. Let's start with the CPI numbers. Those were released on Tuesday and Wednesday, CPI on Tuesday. And what we learned was that for the month, inflation cooled to its lowest annual rate in more than 2 years, which the Federal Reserve certainly appreciated as they were meeting at the time of the release. As you can see on your screen, the CPI number dropped to 4.05, falling from 4.9% the month earlier. However, the core inflation rate, which, remember, that it tracks inflation but excludes the volatile food and energy. Those tend to be a little more volatile. So the core, that came in at 5.33%, down from a year earlier, but still stubbornly higher. Energy was the main number that dropped our regular inflation rate because that dropped for 3.6%, while shelter prices, your home and your rent, those were the largest contributors to the number on the upside. Those were up 0.6. Then on Wednesday, we received the producer price index for the month of May. Now remember, the producer price index tracks the changes in prices that producers, people that make goods, receive for their work. This is a leading indicator for CPI, which came out on Tuesday, meaning you'll see the PPI number go up or down first, and then you'll see that reflected in CPI typically. This number also came in below its pre-pandemic level, dropping from 2.3% level that we saw in April to just 1.09% in the month of May. This number saw a decline thanks to lower energy and food prices at the producer level. Now, we've seen this number decline now 11 straight months, and we haven't seen a level like this since December of 2020. That wrapped up 2 days of inflation numbers with the market feeling pretty good about the trajectory of the U.S. economy in terms of inflation. All of this gave the Federal Reserve the ammo they needed to come out and hold interest rates steady at their current meeting and possibly maybe for the rest of the year. More than half the participants, though, still think and are advocating for future rate increases. As you can see on your screen, at this point, the CME FedWatch tool, this gives us a gauge into sentiment around next month's meeting results in terms of what they're going to do with inflation, which that's going to happen on July 26th. And as of right now, 74.4% chance that interest rates move up another 0.25%. Last month, we looked at the University of Michigan's Consumer Sentiment Survey, which tracks consumer sentiment, how people are feeling about their finances, personal finances, business conditions, and other topics. And that number rose to 63.9. Therefore, we can see the feeling people are having about their future starting to look and feel brighter. If they just would have been watching this video series all year, they wouldn't have been having to worry about a recession, which presumably what took that number lower earlier this year. Initial claims for unemployment insurance that we look at each week to determine if we feel the economy is going to start seeing issues on the job front. That came in at 262,000 this week. Therefore, effectively no real change week over week in that number. And now let's look at how the market turned out this week. The S&P 500, which tracks our growth and our growth and income categories, but only when taken together, not independently, that was positive 2.58% this week. The Russell 2000, which tracks our aggressive growth, smaller and mid-sized company stocks in our Dave Ramsey vernacular, that was positive 0.56%. And finally, the MSCI EAFE, which tracks international stocks, that got back to its winning ways after taking a few weeks off, and that jumped 2.73% for the week. Point number two, let's talk briefly about those initial claims for unemployment insurance numbers. Last week's numbers were revised higher by 1,000 to 262,000, and that's exactly where this week's claims came in at. Hence why you saw that flat line. The consensus expectations amongst economists was that we'd see 249,000 initial claims for unemployment. The longer run average for our current time period is 217,000. So seeing the 262,000 number come in twice now in 2 weeks puts them 2 standard deviations above their current average, which is a notable level and not in a good way. That tells us there certainly is slowing in the labor markets, and we certainly knew that already. If we go back 1 year from today, we were looking at initial claims of 205,890, which we're currently at a 21% increase, which is actually the fastest rate of change since the pandemic. All this together, when you look historically at 20% increases year over year in the initial claims for unemployment insurance, it has always been right before a recession. One was on the horizon, and the data we were able to look at from our friends went back to 1968. So that's a long time to make that claim. The reason we would say this time is different, though, and the last 2 readings may be a false positive, is because of the fact that 217,000, the current average I referenced above, is historically low. And I don't say that with exaggeration. There's no historical precedence for being this low on initial claims for unemployment. Part of the reason why I argued all year through this video series, why are all these smart economists predicting recession? I thought it's groupthink. You can't be at historically low unemployment numbers. Groupthink. It's a dangerous thing. It's why independent firms like us, independent in the view of our research and independent from our investment selection, can be such a powerful thing to you as a client. And point number 3, crypto has got some problems. Not only because of the outright fraud from companies like FTX, but now you've got the situation where the SEC is coming down pretty hard on crypto exchanges like Binance and Coinbase. And these are 2 of the largest crypto exchanges, and they're being sued by the SEC for allegedly breaking the SEC's rules. However, even outside of that drama, I'm probably more interested in this document that's being published by venture capital firm Andreessen Horowitz. It's called The State of the Industry, and it's looking at the state of the industry in crypto. Several things that would give me a massive pause if I were an investor in this space. And in full disclosure, I am not. The amount of active developers, which are the people kind of creating the technology and developing the technology, which you can see on your screen. And these numbers go back to 2016, and it's down 33% from its peak in January of 2022. Additionally, those developers that are just engaging with the technology from an open source code perspective, those have seen a decline of 27%. Now, look at the next 2 data points. This is showing academic research is even losing interest. There have been about 46% less articles being written about the subject. And finally, job search interest, those Google searches for jobs in crypto, that's down nearly 50%. And the question you got to ask is, where is all this attention from job seekers and developers going? And it may continue to happen, by the way, this lost interest, because these numbers have not yet stabilized. And the obvious answer of where it's going is, the thing I would be more excited about personally is artificial intelligence. This sector is getting all the buzz from news media. It's getting all the buzz from new capital in terms of venture funding is going into the space. Therefore, it makes sense that developers, job seekers, academic would be following suit and mitigating to this new technology. When you start losing intellectual capital, then my fear is financial capital is soon going to follow. And finally, point number 4, according to FactSet, Wall Street analysts expect the S&P 500 companies to earn a new record quarterly profit in the 4th quarter of this year. The expectation is that $57.89 a share will be what they generate for the quarter, and that would top the 2nd quarter of 2022, where quarterly earnings came in at $56.69 a share. Definitely an optimistic number, but maybe the consortium of Wall Street analysts are now buying into the no recession notion as well. However, when you dig into why they think those record earnings are going to come about, it comes down to 4 companies. And you can guess which ones they are. Facebook, Meta, which has been through rounds and rounds of layoffs, and that's only improving their bottom line. NVIDIA, which is one of the leaders in artificial intelligence. Google, Alphabet, and Amazon are collectively responsible for about half of the expected 8.2% increase in quarter-over-quarter earnings growth. And it's no surprise that these 4 companies, their stock prices have been growing, and analysts have been revising those numbers up on them all year. Without these increases, there would actually be there would be no record profits for the fourth quarter of this year, according to FactSet, which is helping us to see why the rest of the market is lagging behind these 4 stocks so much. To summarize this, right now analysts think big tech is going to show remarkably strong earnings growth and the rest of the market is just going to be flattish. I can't wait to watch the markets each week with you on these video series and find out if this is true. So we thank you for watching the 4 things we learned in the markets this week. If this video series was helpful for you, would you do us a favor? Would you hit the like button? The like button helps us get our content out to more people. It helps us trick Google and YouTube's algorithms, as well as subscribe to our content. When you subscribe to the content, that allows anything we push out to come to you first through your YouTube feed. And you can also check us out on Rumble as well, too. All of our videos are streamed on Rumble if that's your platform of choice. As well as if you'd like to meet with any of our financial coaches who help you in baby steps 1, 2, and 3, get out of debt, stay out of debt, live on a budget, and hold you accountable, you can hit the link in the comments section. Or you can also meet with any of our financial planners who help you in baby steps 4, 5, 6, eventually to get to baby step 7. That is saving 15% of my income towards retirement, creating a plan to pay off my house, and saving for my kids' college so that later I can live and give like no one else. Thanks so much for watching this week's video. We'll look forward to seeing you next week.